Hello and welcome to the first episode on our series exploring the UK tax regime, starting with capital gains tax. This episode, and the Xenia channel generally, aims to make the often complex world of finance simple and understandable for everyone. Whether you're encountering the subject for the first time, or if you're looking for a simple refresher, we hope you take something useful away from the next few minutes. Today, we're diving into capital gains tax, an often overlooked tax with various rules. It's a levy that many find daunting, but not to fear. We're here to break things down into simplified, easy to digest sections. We'll cover the basics, such as what a capital gain is, how it's calculated, which rates are applicable, and how it's applied to a capital gain. We'll be highlighting the main points you need to know and how these are applied to examples, which we'll work through together. You can skip to specific sections using the video chapters detailed in the scroll bar below. Whether you're selling a property, cashing in on your investments, or just curious about what assets are liable to CGT, as there are many exemptions, this video will give you a good start. The free-to-use Xenia Learning Portal provides a recap on the matters covered in this video, along with further learning and a test to reinforce your knowledge. A link to this section can be found in the description box below. So, grab a cup of coffee and let's demystify capital gains tax together. In very simple terms, CGT is a tax charged if you sell, gift, exchange, or otherwise dispose of an asset and make a profit or gain on your original investment. It's not the amount of money you receive for the asset, but the gain on your investment that is taxed. Generally speaking, to determine the gain, you compare the proceeds from the sale, or in the case of gifting, the value of the asset at the time it was disposed of, with the original purchase cost of the asset, or its value when you acquired it. The difference between these two is your capital gain or potentially your loss. The tax is levied not on the total amount you receive from the asset, referred to as the proceeds of a disposal, but on the profit you make from your investment, that is, the amount in excess of the original cost, that is referred to as the gain. As we'll explore later, there are other costs and expenses, not just the initial investment amount, that can be used to reduce the overall gain subject to CGT. An important note here is that should you realize a loss on the disposal of an asset rather than a gain, this can be registered with the HMRC and carried forward indefinitely. Registered losses, along with any losses in a given tax year, can be used to reduce gains liable to capital gains tax. CGT becomes a consideration whenever you dispose of a capital asset. As far as the taxman is concerned, a capital asset is an asset you have a right to, either in part or full, such as a house, shares in companies, or other possessions. Investors should be mindful of their residency status when disposing of an asset. UK residents are liable to CGT on gains made on disposals anywhere in the world, with some exceptions. Non-residents can avoid UK CGT depending on where a disposal was made. The subject of tax residency is broad, so we won't be going into the ins and outs here, but we'll be exploring this in further videos. CGT should be borne in mind when giving away an asset, referred to as gifting. The taxman will consider a gift a disposal for the purposes of CGT. Amongst other concerns, this is to prevent investors simply handing ownership of assets over to loved ones, removing the initial base cost for CGT purposes, allowing both to share in the proceeds on a later disposal with less CGT to pay. Depending on who you gift assets to can have an implication on whether CGT is payable. For example, an investor can gift an asset to a husband or wife without giving rise to a gain. Instead, the spouse receives the gift with the base cost of the asset paid by the spouse making the gift. In certain scenarios, HMRC will consider the loss of an asset, say by way of destruction, as a disposal for CGT purposes. This will usually be in instances where you receive a payout from an insurance policy. Let's say you own a valuable piece of art for which you take out an insurance policy to pay a lump sum should the artwork be damaged. If the piece of art becomes damaged enough for the insurance policy to pay out a lump sum, and this amount exceeds the market value of the painting at the date of destruction, HMRC would consider this a capital gain for CGT purposes. For more details on how your residency status is considered for UK CGT, and further rules surrounding gifts, such as the gift of business assets, visit our learning page detailed in the description below. There are a number of assets that, when disposed of, even at a capital gain, are not considered for capital gains purposes. These are referred to as exempt assets. Assets that can be sold without a CGT liability include gains realised within tax wrappers, such as ISAs and pensions, capital gains realised following the sale of government bonds, referred to as gilts, the gift of assets to UK registered charities. Remember that a gift is a disposal, therefore any gain on such an asset is normally considered for CGT. A gift to a UK charity allows an investor to ignore any gains on the disposal. Any proceeds from betting or gambling, regardless if this is your hobby or main source of income. Certain products offered by National Savings and Investments, referred to as NS&I, gains realised following the sale of cars held in investors' personal names, including vintage cars. Any gains realised following the sale of your home, referred to as your main residence. Homeowners with more than one residential property are able to elect which property is their main residence, also referred to as the primary residence. This option to elect your main residence can present some complexity when establishing the CGT payable on disposal of subsequent properties that aren't your elected home. As an example, consider you purchase your first home, which you live in for 5 years. In year 6, you buy a second residential property, which you move into and elect as your main residence. This new election makes your first property purchase a secondary residence. Let's say after 10 years of property ownership, you decide to sell both properties. Any gains made on your first property will be liable to CGT, but only for the time this was not your main residence. In this instance, you will be exempt from 50% of any capital gains tax due on this first property, as this was your main residence for 5 out of 10 years of ownership. Your second property purchase will be fully exempt from capital gains tax, as you elected this as your main residence from the date of purchase. HMRC has a couple of interesting rules when considering assets that they consider tangible and movable, which they refer to as chattels. Assets such as art, antiques, jewellery, fine wine, racehorses, and collectibles fall into this category. These assets have separate rules for capital gains tax depending on their expected lifespan. Chattels that are expected to last for less than 50 years are considered wasting chattels. Gains on these assets are completely exempt from CGT. If you're lucky enough to make a profit on an asset such as a racehorse or fine wine, the taxman will overlook these gains for the purposes of CGT. Non-wasting chattels, that is, assets with an expected useful life of more than 50 years, do, however, incur CGT on capital gains on disposal, but they have some special rules. Simply put, non-wasting chattels sold with proceeds, not gains, of less than 6,000 are exempt from CGT. If proceeds exceed 6,000, there's a special calculation applied to establish the gain. We won't cover these calculations here, but we've detailed a couple of examples of how this works in practice on the Xenia Learning Portal. Now we know when CGT needs to be considered and which assets are liable to CGT, we can take a look at how a capital gain is calculated. To calculate a gain on an asset, we'll need details related to the purchase of the asset, any costs related to the asset, and the total proceeds received following disposal of the asset, or the market value in the instance of gifting. As a simple example, let's say you bought shares in a company worth £5,000. 3 years later, you sell these shares for £8,000, realizing a healthy gain of £3,000 on your original investment. Buying these shares comes at a price, as does selling them. In this instance, you've paid stamp duty reserve tax on purchase of the shares of £25, and your stockbroker has taken a fee of £80 for facilitating the sale of shares. To figure out the gain on this particular sale, we take the value of the proceeds, in this instance £8,000. We then deduct the original cost of £5,000. We can also deduct incidental costs from the proceeds, in this case the stamp duty reserve tax and stockbroker's fees, leaving us with a total gain of £2,895 for CGT purposes. If you own an asset that you've improved over the course of ownership, let's say the addition of an extension to a property, these improvement costs can be deducted from proceeds, further reducing a gain on later disposal. As illustrated here, it's always important to keep details of transactions in relation to assets that are liable to CGT, so you can establish the gain due on any disposal. Should you lose details of the purchase price or improvement costs of assets, you can end up paying more CGT than necessary. There is a set allowance provided by the government for use against capital gains per individual per tax year, called the annual exempt amount, or AEA. For simplicity, we'll refer to this as the annual exemption. This amount can be used to reduce a gain that is liable to capital gains tax. The allowance in the current tax year is £3,000. If we take the example in the previous section of share sales, where the total gain was £2,895, the full amount would be exempt from CGT, as the gain falls within the annual exemption of £3,000. The investor in this example would also have £105 available to use against any other gains within the same tax year, that is, his unused annual exemption. Unfortunately, unused annual exemptions cannot be carried forward to future tax years and are lost if unused. It's worth noting that the annual exemption has fallen dramatically in recent years. In the previous 2023-24 tax year, the annual exemption was £6,000, double what it is today, and £12,300 in the previous 2022-23 tax year. This may continue to fall, but we don't have a crystal ball, so watch this space. Not everyone who disposes of UK assets is entitled to the annual exemption. If you are UK resident but not domiciled and claiming the remittance basis of taxation, you'll not have use of the annual exemption. The remittance basis of taxation is a complex subject which we'll save for another video. The big question is, now we know what the gain is on the disposal of an asset, is what rate of capital gains tax, or percent, is applied to this gain. We need to consider two areas to establish the applicable CGT rate. Firstly, what is the investor's rate of income tax? And secondly, what asset is being disposed of? Basic rate taxpayers will pay 10% capital gains tax on the gains realized following the disposal of assets, whereas higher and additional rate taxpayers will pay 20% CGT on gains. The disposal of property that is not covered by the main residence relief, as mentioned earlier, will be charged at the significantly higher rate of 18% for basic rate taxpayers and 24% for higher and additional rate taxpayers. Owners of business assets are able to dispose of these assets with gains taxed at 10%, regardless of their income tax status. This is referred to as business asset disposal relief, and this lower rate of CGT is available on the disposal of business assets up to a generous £1 million lifetime allowance. There is a chance that the disposal of an asset will realise a gain that pushes basic rate taxpayers into a higher rate taxpayer band, meaning a gain on a single asset will be liable to both 10% and 20% rates, or 18% and 24% rate for the disposal of property. We'll explore this further in the next section. For viewers who are Scottish or Welsh taxpayers, note that the same rules above apply. We've included further details on how to establish your UK equivalent income tax bands for CGT purposes, which can be found on our learning portal. Bringing together what we've learned in the previous sections, let's work through an example. Hannah owns 2 residential properties and is now considering the sale of her non-main residence to raise a capital lump sum. She'd like to know what amount of CGT would be payable following the sale of this property. She tells us that the property was bought for £150,000 5 years ago. She has not elected for this property to be her main residence during ownership, so she cannot claim the main residence exemption. It cost Hannah £3,000 in legal and estate agency fees to buy the property, and she estimates it'll cost a further £5,000 in the same fees to sell the property. She also spent £15,000 on an extension. Based on current market prices, she estimates the property will sell for £200,000. So, firstly, we deduct the purchase cost from the assumed disposal proceeds of £200,000. Then the incidental costs of £5,000 and £3,000, and the improvement cost of £15,000. On disposal of this property, Hannah can expect to realise a gain of £27,000. She has no other gains in the current tax year and can therefore use her £3,000 annual exempt amount to reduce her gain liable to CGT from £27,000 down to £24,000. She disposed of a small holding in shares 3 years ago that realised an unfortunate loss of £1,000, which she registered with HMRC. She will elect to use that loss to further reduce her gain from £24,000 down to £23,000. Hannah is a basic rate taxpayer after the deduction of her personal allowance and other allowable deductions for income tax purposes. She earns £25,000 per year. We'll cover the nitty-gritty of income tax in another video, but for the purposes of this example, Hannah has £12,700 of her basic rate tax band left. Any earnings over her basic rate band will be liable to higher rate tax. The gains on Hannah's property exceed her remaining basic rate band, meaning the gain on the single asset after the deduction of her annual exemption and losses will be liable to both tax rates. Therefore, £12,700 of the £23,000 gain, the amount within her remaining basic rate band, will be liable to 18% capital gains tax, whilst the remaining £10,300 will be taxed at the higher rate for residential property sales of 24%. Hannah would then expect to pay capital gains tax of £2,286 at the basic rate and £2,472 at the higher rate, £4,758 altogether. Her net gain after CGT for the sale of her property would then be £18,242. Hopefully this video demonstrates how the calculation of a capital gain is fairly straightforward. The difficulty is establishing the correct gain and the applicable CGT rate after application of the wide range of rules set out by the taxman. This video provides a good guide on the subject and covers some simple disposal examples. If you'd like to take a deeper dive into capital gains tax, the Xenia Learning page takes a look at more advanced elements of CGT, including disposals of inherited assets, CGT treatment of part disposals, and the calculation of gains on chattels in excess of 6,000. We've also provided a test based on this video that will help you reinforce your knowledge. If there's any specific areas regarding CGT you'd like to discuss, or any areas of finance you'd like explained in further videos, don't hesitate to leave us a comment or get in touch with us directly. We're happy to help on an individual basis. Remember that if you're looking to dispose of an asset, it's always wise to consult a professional before doing so, as you may end up paying more tax than intended. Until next time, plan smart and prosper.